Put down whatever you were reading. Close whatever chart you had open. Because what just happened in the silver market in the last 24 hours is not a routine price move. It is not a technical bounce off a support level. It is not managed money repositioning or algorithmic short covering or any of the other mechanical explanations that financial commentators reach for when they do not want to do the work of explaining what is actually driving a market. What happened today is a signal, a very specific, very loud, very historically significant signal. And the investors who understand what that signal is saying, not just about today, not just about this week, but about the next 6 to 12 months in the precious metals market, are the investors who are going to be positioned for one of the most explosive moves this metal has seen in its modern history. Here's what happened. Silver just jumped more than 6% in a single trading session, 6% in one day, to above $77 per ounce, its highest level since April 21st. That is not a drift higher. That is not a gradual recovery from the war-driven sell-off we have been tracking for 10 weeks. That is a single session explosion that wiped out weeks of selling pressure in one move. And it happened for a reason that goes far deeper than the headline explanation every financial outlet is giving you right now. Today is Wednesday, May 6th, 2026. Asian guy here. And the headline explanation, silver jumped on Iran de-escalation hopes, is true. But it is the least important part of the story. Because what I need to walk you through today is not just why silver moved 6% this session. It is what the specific nature of the Iran deal that is being negotiated right now means for the structural setup of gold and silver over the next 6 to 12 months. It is why the removal of the war discount that has been suppressing silver for 10 weeks does not just return silver to where it was before the war. It returns silver to a market that has been building fundamental pressure, supply deficits, AI capex demand, sovereign accumulation, monetary repricing for months. And when that fundamental pressure is released from the suppression of war-driven rate fears and industrial demand discounts, the move is not back to the pre-war price. The move is to price discovery that reflects the accumulated fundamental pressure. That move, the move that begins when the war discount closes, is the move toward record highs. Let me show you the engine, because today's 6% is the exhaust, and the engine has been building pressure for 10 weeks. Let me start with the deal itself, because the financial media has given you the headline without giving you the structure. And the structure of this deal, the specific terms being negotiated between Washington and Tehran, is the most important input for understanding what happens to silver and gold from here. According to Axios, the White House is closer to a deal with Iran than at any point since the war began. And this is not a vague framework agreement. This is a structured proposal with specific, verifiable terms. Iran would accept enhanced UN inspections of its nuclear facilities. Iran would halt nuclear enrichment for 12 to 15 years. Iran would potentially transfer its highly enriched uranium stockpile abroad, removing it from Iranian soil entirely. Iran would limit the activity of its underground nuclear facilities. In return, the United States would gradually lift the sanctions that have been strangling the Iranian economy. The U.S. would unfreeze billions of dollars in Iranian assets that have been locked in the international financial system. And critically, the naval blockade that has been disrupting Strait of Hormuz traffic and driving oil above $112 per barrel would be progressively lifted as the deal milestones are met. Now I need you to understand why the specific structure of this deal matters so much more than just the headline, Iran deal close. Because the terms I just described are not a ceasefire. They are not a temporary pause in hostilities. They are a comprehensive, verifiable, multi-year agreement that, if implemented, removes the fundamental source of the energy supply disruption that has been driving inflation fears, suppressing rate cut expectations, and creating the specific macro configuration that has been the primary headwind for silver for 10 weeks. Think about what disappears when the Strait of Hormuz reopens fully. Oil does not go from $112 back to $112. It goes back toward $80. That is a 28% decline in energy prices from current levels. A 28% decline in energy prices does not produce a modest easing of inflation. It produces a significant, rapid deceleration in headline CPI and PCE that the Federal Reserve cannot ignore. And when the Fed sees inflation decelerating because the energy supply shock that was driving it has resolved, the rate hike scenario that traders were pricing in for 2027 goes from a serious possibility to a tail risk. Rate cut expectations come back. Real interest rates move toward more negative territory. And the macro environment that is most historically supportive of silver and gold, negative real rates, dollar weakness, declining energy inflation, reasserts itself with a speed and clarity that the managed money funds sitting on reduced precious metals exposure cannot ignore. This is why today's 6% move is not the move. Today's 6% move is the market beginning to reprice the probability that the deal gets done. The actual move, the move that happens when the deal is signed, when the strait reopens, when oil drops 28%, when the rate cut narrative comes back, that move is significantly larger. And the investors who are positioned today, while the deal is still in negotiation and the outcome is not yet certain, are the investors who capture the full move rather than chasing it after the fact. Let me now walk you through the arithmetic of what happens to silver when the war discount closes. Because I want to be precise about this. I do not want to just say silver goes higher. I want to show you the specific mechanism by which the removal of the war-driven headwinds translates into a higher silver price, and what that higher price looks like relative to where we are right now. Start with where silver was before the war. In late February, before the Iran conflict began, silver was trading in a range that reflected the fundamental supply-demand picture of the market, without the war discount applied. That level was significantly above $73. The war discount, the combination of energy inflation driving rate hike fears, industrial demand being discounted on recession worries, and institutional deleveraging in response to geopolitical uncertainty, pushed silver down 22% from its pre-war level. Silver at $73, where it was trading before today's 6% surge, was silver at $73 because of the war, not because of the fundamentals. When the war discount closes, when the deal is signed and the macro headwinds that created the discount begin to reverse, silver does not just return to its pre-war level. It returns to its pre-war level plus the fundamental pressure that has been building during the war. The solar demand that has continued regardless of the Iran situation. The AI infrastructure CapEx that has been committed and is now being deployed. The central bank accumulation that the World Gold Council documented in its Q1 2026 report. The supply deficit that has continued widening because mines cannot respond to rising demand quickly, regardless of what geopolitics are doing. All of that fundamental pressure has been building for 10 weeks underneath a price that was being held down by war-driven macro fears. When those fears resolve, the price does not just recover the war discount. It discovers the level at which the fundamental supply-demand picture actually clears. And that level, based on Bank of America's $86 target and the supply-demand models we have discussed in recent videos, is significantly above the pre-war price. Now add the positioning dynamic. The managed money funds that reduced their silver exposure during the war, the institutional deleveraging that I described as one of the three components of the war discount, are now going to rebuild those positions. Not slowly, not patiently, with urgency. Because managed money funds that are underweight silver when silver is moving 6% in a single session are watching their relative performance suffer in real time. Their risk managers are getting questions. Their investors are asking why they missed the move. And the response to that pressure is buying. Concentrated, urgent buying into a market where physical supply is already tight, and the fundamental buyers, the industrial users, the sovereign accumulators, the monetary investors, are also active. When managed money buying meets tight physical supply, meets resolving macro headwinds, meets Bank of America's $86 target being widely discussed, that is the setup for the kind of move that takes silver from $77 today to levels that the mainstream financial press will describe as shocking, and that anyone who has been following the fundamental story for the past 6 months will recognize as the natural conclusion of everything the data has been pointing toward. Now I need to address something directly, because there have been previous moments in this conflict where de-escalation hopes sparked rallies in gold and silver that subsequently faded when the hopes proved premature. The ceasefire that was established a month ago, the Project Freedom announcement from Trump last weekend. Each of those created a brief rally followed by a reversal when the reality of the ongoing conflict reasserted itself. And I know that some investors watching today's 6% move are wondering, is this just another head fake? Is this another hope rally that fades when the deal falls apart? That is a legitimate question. And the answer requires you to look at what is different about today's news relative to the previous de-escalation signals that failed to sustain. The previous ceasefire was a pause in offensive operations. It did not address the fundamental source of the conflict, Iran's nuclear program, and it did not include any mechanism for reopening the Strait of Hormuz to Iranian shipping. That is why it failed to produce a sustained rally in silver. Because the market correctly identified that a ceasefire which left the energy supply disruption in place did not remove the war discount from silver. The strait was still partially closed. Oil was still elevated. Rate hike fears were still present. The macro headwinds that were suppressing silver had not been addressed. Project Freedom was an operational initiative to escort non-Iranian vessels through the strait. It was a partial logistics solution that did not address the political and military standoff driving the disruption. The market correctly identified that as well. A partial logistics solution that leaves the underlying conflict unresolved does not remove the war discount. It slightly reduces one component of it. What is different today is that the Axios report describes a comprehensive nuclear agreement, not a ceasefire, not a logistics workaround, but a deal that addresses the fundamental source of the conflict. 12 to 15 years of halted enrichment, enhanced UN inspections, potential transfer of highly enriched uranium abroad, gradual sanction relief, and asset unfreezing. This is the kind of agreement that, if implemented, removes every component of the war discount simultaneously. Not the ceasefire component alone, not the logistics component alone, all of it. The energy supply disruption resolves, oil drops, inflation decelerates, rate cut expectations return, the industrial demand discount on silver evaporates, the institutional deleveraging reverses. And critically, this deal has a structural quality that the previous de-escalation signals lacked. The specific terms, the 12 to 15-year timeline, the UN inspection mechanism, the uranium transfer requirement, are verifiable. They are not a handshake agreement between adversaries who have broken previous commitments. They are a framework that, if signed, creates international accountability mechanisms that make reversal politically costly for both sides. That verifiability is the reason today's signal is different, and it is the reason the 6% move today is not a head fake. It is the beginning of the war discount closing. Let me talk about record highs because I use that phrase in the title, and I want to be precise about what it means and how the math gets you there. Because record highs is not a vague aspiration. It is a specific price level that has a specific set of conditions required to reach it. And I want to show you that those conditions are not distant or theoretical. They are assembling right now in real time. Silver's all-time nominal high is $49.51, set in April 2011 during the post-financial crisis precious metals bull run. In this current cycle, silver reached a high of approximately $130 earlier in the bull run before the mid-cycle correction, and then the war-driven sell-off pushed it back to $73. The $130 level already represented a new all-time high for silver in nominal terms, well above the 2011 record. And the question of whether silver can reach and sustain levels above $130, pushing deeper into record-high territory, is the question that the deal news today is directly relevant to. Here's the math. Silver at $130 was achieved in an environment where the war discount was not yet in place, but managed money was heavily long and speculative excess was building. The market that existed at $130 was a market with both fundamental buying and significant speculative froth. That speculative froth was what the mid-cycle correction cleaned out. The market that exists today, silver at $77 after a 6% session, with the war discount beginning to close, with managed money significantly underweight, with the fundamental supply-demand picture intact, and in most cases stronger than it was at $130, is a fundamentally cleaner market. It is a market where the next move higher will be driven by fundamental buying, rebuilding on top of a cleared speculative base, rather than speculative excess building on top of fundamental buying. And fundamental-driven moves in commodity markets tend to be more durable and ultimately larger than speculative-driven moves because they are not subject to the same margin call cascade risk that terminated the previous run. Bank of America has an $86 average target for silver in 2026. That is a conservative baseline that assumes normal execution of the fundamental thesis without a dramatic acceleration. If the Iran deal closes, if oil drops 28% from $112 to the low 80s, if rate cut expectations return and the dollar weakens, if managed money rebuilds its silver long exposure from historically depressed levels, the conditions that existed when silver was at $130 reassert themselves from a much cleaner positioning base. And a cleaner positioning base with the same or stronger fundamental drivers does not produce the same price as the previous run. It produces a higher price. How much higher depends on the pace of managed money rebuilding and the degree to which the fundamental demand drivers, AI capex, solar, sovereign accumulation, accelerate relative to supply. But the direction is not ambiguous. The direction is toward and potentially through the $130 level, into territory that, for silver priced in today's dollars, is genuinely record high. Let me close with what this means practically, because frameworks without application are intellectual exercises. And I do not make these videos for intellectual exercises. Silver is at $77 after a 6% session. The Iran deal that, if completed, removes every component of the war discount simultaneously, is closer to being signed than at any point since the war began. Gold is recovering toward $4,630. Oil is falling toward $108 on deal optimism. The dollar is weakening. The managed money funds that deleveraged their precious metals exposure during the war are beginning to rebuild. And the fundamental supply-demand picture, the supply deficit, the AI CapEx demand wave, the solar build-out, the sovereign accumulation, has been building pressure for 10 weeks underneath a price that was suppressed by war-driven macro fears. The investors who are positioned right now, before the deal is signed, before oil drops 28%, before rate cut expectations are fully repriced, before managed money has rebuilt its silver long exposure, those investors are positioned for the full move, not the partial move, not the move from $77 back to the pre-war level. The move from $77 through the pre-war level to the price discovery that reflects both the removal of the war discount and the accumulated fundamental pressure that built during the war. And here is the critical timing point. The deal is close but not done. The Axios report says the White House is close, not that the deal is signed, which means there is still a window that closes the moment the agreement is announced and the market fully reprices the new reality in a single overnight session that retail investors who were not already positioned cannot participate in at reasonable prices. This is the window. Today's 6% move is the market beginning to price the probability of the deal. The move when the deal is confirmed is the move that takes silver from wherever it is trading that day to significantly higher levels in a very short period. The investors who understand that distinction, who are positioned during the probability repricing rather than chasing the confirmation spike, are the ones who capture the full asymmetric return that this setup offers. Silver at $77 with an Iran deal almost signed is not expensive. It is the last reasonable entry point before the war discount closes entirely and the fundamental price discovery begins in earnest. The 6% today was the signal. The move that follows the deal is the story. And the investors who read the signal correctly today will be the ones telling that story from the right side of the trade. This is Asian Guy. If this breakdown gave you the framework to understand why today's 6% is not the move, but the beginning of the move, why the war discount closing is more powerful than a single session surge, why the Iran deal structure is different from every previous de-escalation signal that failed, and why silver at $77 with a deal this close is a fundamentally different setup than silver at $77 in the middle of an escalating conflict. Like this video and share it with one person who needs to understand what is happening in this market today. The deal is almost here. The war discount is closing, and the fundamental engine that has been building pressure for 10 weeks is about to be released. Do not wait for the headline to confirm what the data is already saying.